Here's some examples on debt instruments, both single debt instruments and a portfolio, with both amortized cost and fair value methods. So for this example, a company purchases $75,000 in bonds as an investment. The stated rate on the bond is 8%, so the effective rate is 10%. So you know going in it's already going to be a discount. If you go ahead and plug this in, knowing the term is 5 years with interest payable semi-annually, the present value or the issue price is going to be $69,208. So the first entry we're going to show is how to record the purchase of the bonds as an investment. That entry is easy, one you probably figured out already. You debit debt instruments, credit cash for the price paid of $69,208. The next thing you want to do is set up an amortization schedule to bring the debt instruments up to the $75,000. And it really doesn't matter if you're going to use the fair value method or the amortized cost. You're still going to make the same initial entries for the first year. So your entry on the purchase and your entry for the first year's interest are going to be the same. You may as well set up your amortization schedule. So here's your amortization schedule. It's easy enough. We know that the stated rate is 8%. So 8% is how we determined that the cash payment each year is going to be $6,000, but it's going to be in $3,000 increments. It's going to be paid twice a year. And then the interest is based on the effective rate. The effective rate is 10%, but it's payable semi-annually, so each of the interest amounts is 5% of the carrying value. So you fill it out. When you're finished, your carrying value of the bonds should be at the fully amortized cost and at $75,000. Your entry at the end of the first year should be to record the cash received of $3,000, the fact you have to recognize interest of $34.60, and you've got to amortize $460. So the entry is very easy. Debit cash $3,000, debit debt instruments $460, credit interest revenue for $34.60. And that brings the carrying value of the bonds from $69,208 to $69,669. At the end of the year, on December 31st, you're going to make the same entry, except you're going to use a different amount. You're still going to have $3,000 in cash, but your interest revenue is $34.83 and your amortization is $483. The other thing is we're saying we're receiving this on June 30th. And that's fine. And if you receive it on December 31st, you would debit cash. But what if you're going to receive it on January 1st? You still have earned the interest during 2018, so we still have to make the journal entry for 2018. But instead of debiting cash, we're going to debit interest receivable. So here's the entry. The $3,000 in cash is received, the revenue of $34.83, and the amortization of $483. If you're using the amortized cost method, you're going to keep making these entries all the way through the life of the investment until you end up with a carrying value of $75,000. But you also need to make sure you show it properly on your balance sheet and income statement. So this is what they look like. And one of the things to note is at the end of the year, the end of 2018, the carrying value of the bond is $70,152. So on your balance sheet, you have your $3,000 in interest receivable. You've got your long-term investments that you're properly labeling debt investments held to maturity because you're holding on to that bond at $70,152. And your interest revenue from the year is a total of those two journal entries that you made at $6,944. That's how you handle debt investments with the amortized cost method. But what do you do if you sell? Now, in this case, we're going to sell it just before the end of the maturity period. So we're going to sell it between June and December. and we're going to sell it on October 31st, 2022. Sell it at a price of 99.750, or basically 99.75% plus interest. One of the things that happens is you're still going to get the interest payment. The people who are buying it are going to get the interest payment, and they're going to get the full $3,000. But they didn't earn the $3,000. You earned a portion of it. So you're going to pick up the portion that you earned here and there. And actually, you're going to pick up your portion of the $37.14, because that's the effective interest rate that we're going to deal with. The easiest thing to do is just to expand your effective interest table. Just add, after you come up with the June 30th line, add a line for the October, and then put in 4 months. So 4 out of the 6 months is going to be $2,000 that you're going to receive in cash instead of 3. And your interest revenue is going to be principal times rate times time, and your time is going to be 4 months out of 12 instead of the 6. But you end up with a carrying value at $74,761. So one of the things you have to do is record your interest to that point, because you want to make sure your carrying value of the bond is up to date. So you're going to go ahead and make an entry. You're going to debit debt investments, and you're going to credit interest revenue for the $476. That will bring the carrying value to its proper amount at $74,761. So we also need to figure out how much gain or loss there is on the sale. Well, if we've got a value of $75,000 and we sold it for 99.75%, then we receive $74,813 for the investment. So we've got the right amount listed as the sale on the investment. We're going to subtract out the carrying value on the books, and we actually have a gain on the sale of the bond of $52. But we said we sold the bond at 99.75 plus interest. So that's not the total cash we received. That's just the cash we received for the bond side. We have to add the interest side as well. Now, we know that the bond was priced at $74,813, but we sold it with the interest. And we also know that we've recorded the amortization of $476 in interest. But total interest revenue is $24.76. So we've got to finish and record the other $2,000. And this is the $2,000 we're receiving in advance on the bond. It's not part of the effective interest. It's actually the cash we're going to receive from the seller, because the seller's going to turn around in 2 months, they're going to receive $3,000. So they're giving us the $2,000 we earned. So we've got the sale of the bonds, the $74,813, which has the other $4,676 built into it. The accrued interest we have of $2,000, and the total cash we've received is $76,813. Now, we're only going to record the accrued interest here of the $2,000, because like I said, we've already recorded the $476. So we're going to record the cash of $76,813, the interest of $2,000. We're going to take the bond off the books at the carrying value of $74,761 and record the gain on the sale. So here's how everything comes out in the entry. Our cash is recorded here as a debit. Our interest, you can also calculate that you know you're going to receive the interest that's coming from the seller. It's $4,600 to the $3,000 they would do, or you can go ahead and do it according to the amortization schedule. And that's $2,000. We're taking it off the books at $74,761, and we're recording the gain of $52. And that's how you record the selling of a debt investment that was done with the amortized cost method. But what about the fair value method? Now, with the amortized cost, the example I used was a discount. You could do the same thing with a premium, except you would be reducing the carrying value. So, for illustration purposes, here's a debt investments with the fair value method, and this is done with a premium. the stated rate's 10% and the effective interest rate is 8%. And the bonds sell for an amount, but you're on the purchasing side. So you bought them for $86,488, which had a premium of $6,488. The entry to record the purchase is the same as it is for the amortized cost method. You debit investments and credit cash for the amount paid for the investment. You do the same amortization table, except because this is a premium, you start with $86,000 and you end up with what's $80,000. And I left it here at $79,999 to show you that there's rounding that occurs. And that's just one of the things to do, take it out for an extra decimal place and get rid of the rounding. And your entry on June 30th would be a debit to the cash for $4,000, credit interest revenue for $34.60, and credit debt instruments for $540. That reduces the carrying value of the bond from $86,488 to $85,948. Your entry on December 31st is the same for the amortized method as the fair value method. You're going to debit interest receivable because it's December 31st and you're not going to receive the cash till January 1st. So you're going to debit the interest receivable for $4,000. You're going to record the interest revenue at $34.38, and you're going to amortize by crediting debt instruments for $562. The difference is you stop at the end of 2018, and you have a carrying value of $85,385. What is the fair value? And you're going to have to make an adjustment for this. So when we first recorded the bond at a premium, that's because the stated rate was much higher than the market rate. But let's say that the market rate has now increased and the bond can be issued at par, so the fair value is $80,000. And it could be any number you've been given. But the carrying value in the amortization table is for $85,385. So you, in essence, your investment has a loss of $5,385. So you need to record your loss. You also need to take into account any prior adjustments that have been done to the fair value adjustment balance. We're doing this for this example here for this year, but we could have one that's got some prior years in it. And so if we state this bond here with the cost of $85,385 and a fair value of $80,000, we've got our loss of $53.85. But let's just say that we had a previous fair value adjustment balance that had a debit balance of $1,111, then that must mean we need to make a fair value adjustment with a credit to $6,496. And you always need to take into consideration what has been done before. So the journal entry is a debit to unrealized holding gain or loss in equity and a credit to the fair value adjustment for $6,496. Now the adjustment portion related to these bonds is going to be the $53.85. So if we're going to sell the bond, we're going to need to reduce this amount. So what do we do if we sell the bonds at 99.75 plus interest? The fair value adjustment now needs to be 0. So for this amount, we would debit fair value adjustment because we had credited it earlier. We would debit it and credit unrealized holding gain or loss income for the $53.85. And we've removed it from the books properly. And that's the fair value method for handling debt investments. But what do you do if there's an entire portfolio? Well, for this example, we've got 2 bonds here, and we've got a cost and a fair value and unrealized gain or loss for the year. So just think of them this way. The amortized cost is according to our effective interest amount. Fair value has to be given. We're going to total those, And the total of the portfolio says there's a loss of $11,397. Let's say this is the first year, so we have no prior adjustment in that balance. And therefore, we need to make an initial adjustment because we need to make the balance in the fair value adjustment account $11,397, and it's got to be a credit because we're going to be debiting the unrealized holding gain or loss. So when you think about what you're doing, you're debiting your losses and you're crediting the gain. So you debit the unrealized holding gain or loss, and you're going to credit the fair value adjustment to balance it out. So this is what your entry looks like. And what do you do if one of the bonds sells? So for this example, let's say Willis bond sold for $75,000 and it had an amortized cost of $76,147. Well, the selling price of the bond is here, the amortized cost, so you had a loss on the sale of the bonds of $1,147. We know that we're going to have to debit cash for the amount of the sale, and we know we're going to have to credit debt instruments to get it off the books. So our loss is going to show up properly because we are going to end up debiting the loss, and you debit a loss just like you debit an expense. You credit a gain just like you credit the revenue. So they're on the right balance side, and you've done everything you're supposed to. You've recorded the cash, you've recorded the loss, and you've removed the debt investments from your books. So now what do you do if the value of Davis, the fair value at the end of the next year, is $147,000? Well, you set up your schedule the same way we did the first time, except you don't have a Willis account in there. You're just leaving it with the Davis amount. You've got a cost of $150,000, a fair value of $147,000. So again, you have a $3,000 loss. The total of the portfolio is a $3,000 loss. Previously, you had an $11,000 loss. So your loss isn't as big as it was before. So your journal entry is to actually debit your fair value adjustment and credit your unrealized holding gain or loss for the $8,397. Because when you're finished, you should only have $3,000 left in that account. So you went from a loss of $11,000 to only a loss of $3,000. You regained a portion of it. So you're picking up that gain by crediting the unrealized holding gain or loss, and you're balancing that account by debiting the fair value adjustment. And that's how you deal with a portfolio. And those are your entries for debt investments, both individual and a portfolio, with the amortized cost and the fair value methods.